everyone. How do you use this? Oh, there we go. Okay, so I'm Jessica. I'm going to do a brief overview of the recent and upcoming accounting changes in IFRS. So overall, we're mostly going to focus on the changes that happened for 2013, and we'll touch on the changes expected in 2014 and thereafter. The changes are relatively minimal and limited in scope, but the devil is in the details, so it's important to read the sections if they could apply to you. Like Arez was saying, helps if you guys read the handbook. There is a couple small clauses that are different from Canadian GAAP and the old standards, and they could cause grief during the audit if we're not aware and we don't address them in advance. So the first one we'll start with is IFRS 10. IFRS 10 addresses consolidation. For the most part, this is fairly consistent with the old Canadian GAAP and IFRS standards, but the key change is that the definition of control has been amended to mean that to have control, an investor needs to have the ability to use its power over the investor to affect its returns. Most of the time when you have a subsidiary, you have legal and beneficial title. Where this might come into play is where you might not have beneficial title, or you have beneficial title without legal title. And that may affect whether or not you want to consolidate the entity. An example I think you guys might relate to is where you have an earn-in agreement in likely a foreign country, and that property is owned by a sub, and you don't own the shares of that sub yet. You're working to earn an interest in that sub so you can own the property, but you're funding it, you're directing its operations, you're effectively controlling what if it has any employees do, but you don't technically own the shares yet. That might be a situation where you have beneficial interest based on the terms of the earn-in agreement, but you don't legally own it, and you might want to consider consolidating it. So this section was effective for January 1, 2013. So you should have it in your December 2013 statements and thereafter. But just to give you an idea, PwC did do a study of this in mid-2013, and of all the companies who adopted it, none had any numerical impact, so it shouldn't be a big one. This section, though, IFRS 11, so this addresses joint ventures, joint operations, and jointly controlled assets. That same PwC study had about 35% of people having an actual change in their figures and a restatement as a result of adopting IFRS 11. So the key element is, there we go. The key element in this one is making sure you establish joint control. If you guys can't establish joint control, you're not in this section. You either have a controlled subsidiary or you have a significant influence investment where it's 20 to 49%. Typically, a joint venture, you'll have 50-50 and that's it. Everyone, you have to have 51% interest to make a decision go through. So if it's 50-50, you have joint control. But some typical areas that cause complications in that would be if you have a board that has an odd number of people, or you have a situation where both parties have equal representation, but one party might have an extra vote in the case of a tie, like a hammer, which is common in order to make business go smoothly, but the existence of that may indicate that you don't have joint control. Another factor that you can consider is if you have one party being nominated as the operator of the project, that can also impact, it could mean that they have decision-making power, and therefore you don't have joint control. That person might have more control than you. So you need to look at those types of situations because these factors may preclude joint control, and then you don't have to worry about this section and you're out of it. Read the agreements carefully, especially the areas around legal rights and obligations each party has regarding decision making. Once you establish joint control, you go on from there, and the arrangement is either classified as a joint operation or a joint venture. A joint venture is when the parties have rights to the net assets of an entity. So a joint venture is typically structured through an incorporated entity, like a separate corporation type of thing. Intuitively, it kind of makes sense. If two companies invest in a corporation, they each have 50%, they don't have a direct right to the assets, and they're not liable for the liabilities of that entity. They're entitled to the net assets, so you would account for it on a net asset or net equity basis. You also have joint operations. These are generally not structured through a separate vehicle. They typically have a mingling of resources and obligations, and each party would then have a direct ownership interest in the actual assets and could be found directly liable for the obligations. So in those cases, you do what's used to be called proportionate consolidation, and now it's a little bit different. You're going to record each line item your direct ownership interest in the cash or the intangible assets, or the liabilities and revenues and expenses, based on what the terms of the agreement would say. An example of a joint operation that's quite common is tech and biotech industries. So what they do is they'll often enter into collaborative research and development projects. Both parties will put in various assets such as intellectual property, cash, certain employees, and they'll have an agreement on how it's going to be split, but they won't actually enter into a formal venture or a formal company. So that type of situation, they're each going to pick up their appropriate percentage of the assets and liabilities that they've contributed or the other parties contributed. So that's joint ventures. IFRS 12, disclosure of interests in other entities. So the purpose of this section was actually to improve transparency to readers. It's a bit of an ambitious section, I think, because their intent was to make big complex entities like Coca-Cola more transparent to the user to understand the implications of how their consolidation works. The focus was to try to disclose risks involved in the ownerships of their underlying entities. So it increases the disclosure around significant investments, subs, joint arrangements. The disclosure will impact companies that have subsidiaries specifically with non-controlling interests. So they want you to disclose interests or risks around, does your non-control or your partner, I guess, who owns 30% have protective rights? Or even though you own 80%, is there any factors that prevent you from being able to sell your share in the open market? Do you have to go to the other person first? Is there a specific valuation method, period of time? Things that could impact the carrying value, I guess, of the investment. They're also going to want you to disclose any risks such as going concern issues with your subsidiaries, or any details of financial support or arrangements. Yeah, it's pretty ambitious. If you do have non-controlling interests, you might want to have a look. They do have quite extensive, significant disclosure requirements. But all in all, for most of our companies, because we aren't Coca-Cola sized, we're generally disclosing a lot of these considerations already. So we do tend to disclose the contractual arrangements and the details because we don't have a ton of other information that's relevant. So IFRS 13, fair value measurements. The goal of this section was to help streamline the disclosure around fair value measurements for non-financial instruments. It was also designed to streamline IFRS and US GAAP. So this, if you have US reporting requirements, this might be of interest also. It'll primarily affect companies that are carrying non-financial assets at fair value. So if you're carrying real estate at fair value, or your mineral property at fair value, or intangible assets at fair value, this would be of concern. It's also actually relevant to consider if you're considering a partial impairment of any of your long-term assets. So if you're carrying an intangible asset at $5 million and you want to impair it to $2 million, this section is going to give you some guidance on the disclosures surrounding how you determined that $2 million was the fair value. So what this section does is it takes that fair value hierarchy that was established within financial instruments that has the level 1, the level 2, and the level 3, where level 1 was prices determined in an active market. Level 2 was of inputs and whatnot that are directly observable in an active market. And level 3 is basically a valuation methodology. So level 1 has the most assurance, is the most independent, with level 3 being more subjective. Basically, if you, let's say, go back to the impairment example, if you're disclosing a property that you're impairing to $2 million, you need to say how you got to that valuation, what level 1, 2, or 3 it is, and any significant assumptions or like discount rates or term or price of gold that you're using to establish that valuation. All in all, if you're not carrying your assets at fair value, this might not be the most pertinent. So before we wrap up, I just wanted to give a quick general update on some other items, because upcoming standard changes in 2014, there really isn't that many. There's a couple minor additions and twerks to IS1 and stripping costs and whatnot, but as Arez was mentioning, if it doesn't pertain to your actual organization, it's not really relevant to disclose. One of the big ones that we've all been disclosing, or most people have been disclosing, is IFRS 9, which was projected to be adopted in 2015. But just recently, last November, the IASB actually deferred the adoption of it indefinitely. So we don't know when it'll be adopted. We don't know what it'll look like when it is to be adopted. So I would suggest it might be something you could consider cutting out of your MD&A and financials, because we don't know when it'll be effective. The other thing I just wanted to give people a heads up on, and there will be more, you'll hear about it more coming up in the next couple of years, revenue recognition and leases. Those are projected to be in effect in 2017, but they're really starting to start the discussion now. They're fairly radical changes within that. With leases, they're proposing to make all leases capital leases. So if you have an office premises lease, they could make you, that means that you would record the total value of your lease payments as an asset, and you would record all of your payments over the term of the lease as a liability. If you're planning to enter into any debt or financing arrangements in the next couple of years, and there might be debt covenants, and then this will be effective in 2017 and significantly increase your debt, it's something you want to be aware of. Likewise with revenue, they're changing the percentage of completion method and some stuff on that. So if revenue is something that you're disclosing, you might want to have a look to see if it's going to impact how much revenue you're showing in 2015 and 2016 when you adopt it.